Why traders break rules after 2 wins. There is a biological reason why your third trade is usually your worst. After 2 wins, your brain stops processing risk and starts chasing dopamine. You think you're reading the market well, but you're not. You're entering the most dangerous psychological state in trading. And if you don't recognize it, the market doesn't need to punish you loudly. It will take everything back quietly. The first win feels good. The second win feels even better. And that's usually where the trouble starts. Nothing dramatic happens. No alarm goes off. Just a subtle shift in how rules feel. They stop feeling like protection. They start feeling optional. After 1 win, traders are cautious. They still respect risk. They still follow the plan. But after 2 wins, confidence inflates. Not confidence in the strategy, but confidence in the self. I'm reading the market well today. I'm in sync. I've got momentum. Momentum is a dangerous word in trading. Markets don't reward momentum thinking, they punish it. This is the overconfidence gap. You aren't actually seeing the market better. Your brain is simply rewarding recent success. Dopamine sharpens focus, speeds decisions, and convinces you that repeating the same behavior will guarantee the same outcome. That's how disciplined traders quietly become reckless. For months, the trader followed rules precisely. Strict stop losses, controlled position size, no impulse trades. The first win felt like luck. The second felt like proof. Nothing about the market changed, only the trader's posture did. Days later, a new setup appeared. On paper, it looked familiar. The structure made sense. The timing felt right. But the system flagged it as higher risk. Normally, that would have been enough to stop the trade. But the mind replayed those 2 wins, clean, controlled, rewarding. Risk started to feel cheaper. Stops felt tight. Waiting felt unnecessary. Position size felt small. Rules that once felt like a safety net now felt like chains. The trader didn't think rules were being broken. They thought rules were being refined. The stop was widened, then ignored. Size was increased, just this once. At first, there was no panic, only rationalization. It's just a pullback. It needs room. This setup is still valid. But dopamine doesn't help you manage loss. It only helps you chase continuation. When the market kept moving the wrong way, panic finally arrived. The exit came late, and the confusion came immediately after. What changed? I was trading so well. This is confirmation bias at work. After 2 wins, the brain filters information differently. Signals that support confidence stand out. Warnings fade into the background. Loss feels distant. Risk feels abstract. And this is why the third trade is so dangerous. Because the danger isn't emotional chaos, it's emotional confidence. After 2 wins, traders don't feel reckless. They feel composed, clear, certain. That certainty changes how risk is perceived. Loss no longer feels like a real outcome. It feels like a temporary inconvenience. This is why traders start mentally spending profits before they're protected. They trade as if the market already owes them. But the market doesn't operate on memory. It doesn't remember your last trade. It doesn't care how clean the execution was. Every trade is a fresh probability event. 2 wins don't increase the odds of the third. They only increase emotional exposure. This is also why traders feel surprised by the loss. Not because it was unlikely, but because their mind had already removed it as a possibility. They weren't prepared to manage loss. They were prepared to continue. And continuation bias is subtle. It doesn't shout, it whispers. Enter faster, size bigger, wait less. Each decision feels small, but stacked together, They create a completely different risk profile, one that was never tested, never planned, never approved. The trader wasn't trading the strategy anymore. They were trading the feeling of being right. The market doesn't care about your streak. It doesn't know you've won twice. It doesn't reward confidence. Professional traders understand this. They know that 2 wins mean they are now at their highest psychological risk. So they don't push harder. They slow down. They reduce size. They become stricter with rules. They trade less, not more. Because fear after a loss is obvious. Confidence after success is invisible. And invisible risks are the most dangerous. The goal of trading isn't to ride confidence, it's to survive it. Because the market punishes emotional peaks more consistently than emotional lows. And the moment you feel in sync is often the moment discipline matters most. Until next time, as we explore why one trade means nothing. See you on the next video.